Ladies and gentlemen, stay with me because the clock has already started. Not metaphorically, not symbolically, the market is moving right now, and the most dangerous mistake anyone can make in moments like this is assuming there will be time later to process what is happening. There won't be. What we are watching unfold is not a forecast, not a scenario, and not a theory. It is a live event driven by math, logistics, and pressure inside the system itself. You are not listening to a recap, you are inside the window, and once this window closes, explanations will arrive too late to matter. Right now, the dominant force in the market is not sentiment, not headlines, and not even central bank rhetoric. It is time compression. Obligations are coming due faster than the system can absorb them. Inventories are moving faster than narratives can be rewritten. And institutions that usually operate months ahead of the public are suddenly reacting day to day, hour to hour. That is your first signal. When the largest players abandon long-term choreography and shift into short-term defense, something has already broken upstream. If you are calm, that is appropriate. Calm is not denial. Calm is what happens when you understand that volatility is confirmation, not danger. The danger was months ago when the structure was still pretending to be stable. What you are seeing now is not risk emerging. It is risk being revealed. And the reveal phase always feels violent, confusing, and contradictory to anyone still looking at the wrong indicators. Let's talk about those indicators, because the most misleading number on your screen right now is the price itself. The number scrolling across financial networks, the spot quote flashing red or green, is not telling you the truth of this market. In fact, under stress conditions like these, price becomes a tool of misdirection. When physical systems strain, paper prices often move in the opposite direction of reality. They fall when stress increases. They spike when supply vanishes. This is not new, but it is rare at this scale. A falling price right now does not mean excess supply. It means forced selling somewhere in the paper chain. It means leverage being unwound. It means someone is raising cash, not because they want to, but because they have to. These are mechanical events, not emotional ones. They are margin-driven, rule-driven, and automatic. When you see sudden downward pressure disconnected from physical availability, that is not weakness. That is the sound of stress transferring from one balance sheet to another. This is where narratives collapse. The old story says price reflects value. The current environment exposes that as a convenience, not a law. When delivery obligations increase while inventories shrink, the price signal becomes distorted by necessity. Those still reading the chart without reading the structure are being fed an illusion. And illusions persist right up until the moment they don't, at which point they disappear all at once. Behind that illusion is the real trigger, the mechanical one, the part of the system that does not care about opinion, delivery, settlement, fulfillment. These are not suggestions, they are requirements. When contracts stand for delivery, metal must move or credibility collapses, and credibility, once lost, does not get patched with liquidity injections or reassuring statements. It breaks trust at the core. What set this in motion was not panic buying from the public. It was not speculation. It was obligation. Too many claims converged on too little available metal, and the system was forced to respond. When that happens, discretion disappears. The system stops asking what it would like to do and starts doing what it must. Bars move, vaults drain, ownership consolidates. This is the phase where the market becomes physical again, whether it wants to or not. Inside the institutions, the response is not theatrical, it is surgical and stressed. Publicly, everything is fine. Privately, desks are scrambling. Risk models that assumed continuous liquidity are being rewritten in real time. Relationships that relied on mutual cooperation are being tested under pressure. This is the part you never see on television because it does not fit a clean narrative. It looks messy, it looks contradictory, it looks like one hand saying calm while the other hand grabs inventory. That grabbing is the tell. Institutions do not rush to secure physical assets unless they believe access will be restricted later. They do not cannibalize counterparties unless cooperation has failed. When large players turn on each other, it is not about profit, it is about survival positioning. It is about being the one holding the asset when the music stops, not the one holding the promise. This brings us to the core divide that defines this entire event: paper versus physical. On one side, you have claims, contracts, derivatives, and representations of metal. On the other side, you have bars that can be delivered, used, consumed, or stored. For decades, these two worlds coexisted peacefully because confidence bridged the gap. As long as everyone believed claims could be converted when needed, conversion was rarely demanded. That belief is eroding now, and once belief erodes, behavior changes instantly. Participants stop trusting the abstraction and start demanding the thing itself. That shift is not gradual, it is binary. One day paper is sufficient, the next day it isn't. We crossed that line quietly without ceremony, and now the consequences are cascading. You can see this clearly when you look beyond a single market and notice that there is no longer one price. There are multiple prices for the same metal depending on where you are and how you try to access it. The quoted spot price is one number. The wholesale physical price is another, the retail price is something else entirely, and in some regions there is no price at all, only unavailability. This fragmentation is not noise, it is signal. Unified pricing requires unified access. Once access fractures, price follows. Regional premiums emerge because logistics cannot keep up. Shipping delays extend because inventory is being hoarded, not circulated. The market stops clearing smoothly and starts rationing implicitly. That is not a temporary glitch. That is a structural symptom. Now bring industry into the picture, because this is where financial stress becomes economic stress. Industrial users do not speculate, they do not trade charts, they secure inputs so factories keep running. When they sense supply risk, they move decisively and without drama. They lock in what they can, when they can, at whatever price is necessary. And when industry enters the competition for physical metal, it does not leave quickly. This is where scarcity accelerates. Financial players can be shaken out by volatility, industry cannot. Once metal is allocated to production pipelines, it is gone from the market. It does not come back as inventory, it comes back as finished goods months or years later, if at all. This is why industrial demand under stress conditions is so powerful. It converts tradable supply into consumed supply. Faced with this acceleration, the system does what it always does. It attempts containment, more liquidity, more paper, more assurances. Price pressure applied to dampen perception. These tools can slow the process, but they cannot reverse it. They are designed to manage sentiment, not replenish metal. And sentiment management fails when the problem is physical. Every suppression attempt right now is buying time, not solving the issue. It is an effort to keep behavior orderly while inventory continues to drain. But time is the one resource that is no longer abundant. Each day that passes under these conditions tightens the corridor. Each day reduces optionality. This is why the tone behind closed doors is not confident. It is compressed. Eventually, the break becomes visible, not announced. Visible, a missed delivery, an extended delay, a rule change, a reclassification. Something that signals the system is no longer behaving normally. When that happens, trust does not erode further. It vanishes. Participants do not wait for confirmation. They adjust immediately because they understand that after a structural break, yesterday's assumptions are liabilities. We are approaching that point now. You can feel it in the way language is changing, in the way explanations are becoming defensive, in the way focus shifts from price to availability, from profit to possession. These are not subtle tells. They are loud to anyone listening for the right things. Which brings us back to time, not as a threat, but as a constraint. The window ahead is narrow, not because someone says it is, but because the math says it is. Inventories are finite, consumption is ongoing, obligations are fixed. When those three collide, the outcome is not negotiable. It resolves one way and one way only, through repricing, restriction, or both. There is no instruction here. None is needed. The system itself is doing the instructing through behavior. Those who understand what they are seeing are not rushing. They are steady. They are not reacting to price. They are observing flow. They are watching where metal moves, not what the chart prints. That is why they remain calm while others grow louder. As we close, understand this clearly. Selling under these conditions is emotional because it assumes the system will revert to normal. Holding is rational because it recognizes that normal has already passed. This is not about optimism or pessimism. It is about alignment with reality. Reality right now is physical, constrained, and accelerating. You are not late. You are early enough to see clearly. And clarity, in moments like this, is the most valuable position of all. Stay steady. Stay observant. This is not the end of the story. It is the point where the story becomes irreversible.